Frank, how many times has that boat gone by?
What boat?
Frank, it's right in front of us, right out in the water.
I don't see it.
Frank, it's passed us like 4 times by now.
I really shouldn't be trading right now.
Frank, you're trading, we're on the beach. How are you even trading? Is that your laptop?
No, it's my phone.
Oh,
We got the mobile version now, remember that?
oh that's right, it's Finder
Yeah,
Mobile.
yeah.
Frank, how many times has that boat gone by?
What boat?
Frank, it's right in front of us, right out in the water.
I don't see it.
Frank, it's passed us like 4 times by now.
I really shouldn't be trading right now.
Frank, you're trading, we're on the beach. How are you even trading? Is that your laptop?
No, it's my phone.
Oh,
We got the mobile version now, remember that?
oh that's right, it's Finder
Yeah,
Mobile.
yeah.
Frank, how many times has that boat gone by?
What boat?
Frank, it's right in front of us, right out in the water.
I don't see it.
Frank, it's passed us like 4 times by now.
Attention A1 Trading Show fans. If you're interested in getting free access to the Edge Finder or our premium trade alerts, listen up. For a limited time, our show's partnered broker Eightcap is giving out free access to our products when you sign up for a new trading account with them. If you already have a broker, you may want to consider switching to Eightcap because of their low trading costs, a wide range of trading assets, and their amazing customer support. If you'd like to get access to our software and Discord server for free, click the link being dropped in the chat right now and ask one of our team members for more information. Don't miss your chance for free products and an award-winning broker. Now, back to the A1 Trading Show.
Hello, everybody. Welcome back to another live stream. Hope you're doing well. Hold on. Let me get my intro music. I got intro music. There it is. Sorry, I am in the middle of writing something. It's like you're sitting in the waiting room right now. I'll be with you in just a moment. Okay. Sorry about that. Sometimes the stream starts and I'm like halfway through a thought, and then I'm like, I got to write this down. And if I don't write it down, I lose it. So, had to write it down. Anyways, welcome back to another live stream. We are here for day 2 of Powell speaking. We have him speaking in just about 40 minutes to go. Today's actually a potentially pretty volatile day. You have 2 really big events, and even though this is an orange folder, don't be fooled. The 10-year bond auction will be very, very important to see how that comes out today, because the thing about bonds, the U.S. Treasury bonds are sold at auction. And the performance, the demand for bonds is either a confidence thing or not a confidence thing. If there's a lot of demand, let's say demand is strong and a lot of bidding is going on for bonds at the prices being asked, what that would suggest is there's confidence in the U.S. economy, but also it would suggest that people are thinking that inflation could come down. And if that is the case, current bond prices probably look pretty attractive. And if current bond prices look pretty attractive because inflation is expected to come down, the market might like that. What would freak out the bond market, or what would freak out the market in general, would be if at bond auctions perform poorly. If you have a poor performance in terms of auctions, that would suggest that there's not a lot of demand at these current levels. I'll show you these current levels that I'm talking about. Let's take a look at the 10-year yield for bonds at these prices. If a lot of people are buying bonds, then this could continue to kind of trend lower, which would be healthy for the rate cut story. However, if bond auctions perform poorly, in order to encourage more buying, the yields offered on bonds would have to go up, so bond prices would go down. I know that if you're somebody who is newer to this subject, this may sound very confusing, but understand that bonds and bond yields have an inverse relationship. When you go buy a bond, right, and you want to get 4.2%, you might say, well, I don't want 4.2. I would like 4.4. I would buy bonds if the yields went up to 4.4. For that yield to go up, the bond prices, the cost per, bond would have to go down. So they have an inverse relationship. So today we'll see what the demand for bonds is looking like at the bond auction. So very, very important event happening today. If you want rate cuts to come this year, which I'm kind of in the camp of thinking that they will, I'd like to see the bond auction go well, right? And if you're a dollar bull, you'd want it to be not going as well. You'd want people to say, we think the economy is going to stay really strong and inflation's not going anywhere and yields got to go higher. Now, also, I am long gold. I've talked about this over and over and over, but for bond auctions today, bond auctions going well would be good for gold. Why? Because bond auction demand would say, well, people are jumping into bonds now because they think the economy will continue to slow and that jobs could come down. And yesterday, we heard from Jerome Powell something really important. I want to kind of just do some note taking with you guys for a minute on what we saw from Jerome Powell said. So here's what he said that kind of stuck out to me. He said, equal risk to jobs and inflation. He said significant progress on inflation. Would like to see more progress before making a cut. Okay. Whoops. So this is kind of what we're working with from yesterday from Jerome Powell. So JP said there's an equal risk between the two of them, which is a change. This was not the case a year ago. A year ago, it was inflation is our problem. And this is what we're going to focus mostly on. We have changed. Times have changed. And Jerome Powell stated very clearly yesterday that he thinks there is equal risk to the jobs part of their mandate as well as the inflation part of their mandate. Remember that the Federal Reserve has two objectives, at least on paper. This is what they say they do. They say that they want to keep maximum employment and stable prices. They say that over and over and over. But it's all in the antics. It's all in the little things when you listen to Jerome Powell speak. And the big one that stuck out to a lot of investors yesterday was there is an equal risk. That is a change in the narrative. He also pointed to the 2.6 PCE percent number year over year. So year over year, he said, well, PCE is at 2.6. And at some point, you got to start saying, well, look, inflation at 2.6 for PCE, is inflation still an issue? Yes, the CPI is still in the threes. But you can't ignore, and the Fed is certainly not ignoring, or Powell is certainly not ignoring the idea, well, look, unemployment rate is now steadily on the rise. Now you might say, well, Nick, 4.1% is historically a fantastically low unemployment number. But remember that when it comes to this stuff, a moving train is really hard to stop. So what the Fed wants to avoid, I want to paint a picture here, and because I really want to kind of highlight how important this chart is now. Because if you look at inflation, we talked endlessly about how important inflation was. Let's talk about this because this is so important. Both of these things are incredibly important. Do I think the Fed should cut rates now? No. But if we get a CPI report, dang, this inflation stat is updating right now. Unfortunately, that will probably not work right now. No, it's updating. But let's go back to where I was starting. So if I go to unemployment rate on the EDGEFINDER, I want to reiterate what we're looking at here. When it came to inflation in the last few years, the Fed was most terrified by inflation when it was rising, okay? So when inflation was doing this, the Fed, all red flags said, this is our number one priority, get inflation to stop rising. Okay, so I know that we're not at 2% for inflation, but we have to think about something. This is what got everyone at the Fed and everyone on Wall Street freaked out, was inflation. I for inflation, okay? Inflation was rising dramatically. That's what got the Fed to say, hikes, hikes, hikes. We'll worry about everything else later, but this inflation cannot happen, right? Inflation is still high. I'm not saying, and prices, just so you know, unfortunately, will never go down. I don't think prices will go down, and you don't actually want them to go down. If prices in the store are going down, everyone's lost their job, and it's another 2008. That was the last time we saw deflation, right? True prices coming down on a overall scale was a terrible, terrible time. So you don't want that to actually happen. You want demand for products and stuff to still rise. You just want it to rise slower. Have we accomplished that? Kind of. Are we at 2% inflation? No, we're not. We're at like 3.3 or something like that on the CPI, or is it 3.4? I'm blanking. Someone tell me, what is inflation at? Because my chart broke for today. I don't know why. So I'm looking at this and I'm saying, okay, look, here's the dilemma now. Now you have unemployment rising. It's no question why Jerome Powell said equal now, because unemployment rate is rising, and technically we've seen some, albeit very mild, inflation progress. We've seen some progress in inflation, but unemployment is starting to move higher. And when that starts, you have to watch that, because when it starts to move higher, that can very quickly accelerate. Does that make sense? Are we on the same page with this? If that made sense to you, do me a big favor, hit the thumbs up button on the stream. Yesterday, I looked at the stream and I think we had 90 likes and we had thousands of people watch the video. So if you guys could do us a big favor on the viewer side, help us out. Thumbs up the stream if this is helpful to you. If you enjoy this stuff, help us out. Again, takes 2 seconds. Just hit the thumbs up on the video. Again, I want to really reiterate what I'm talking about here is that you may see rate cuts because they don't want to see unemployment start to accelerate higher. Now, is that the right call? CPI is 3.3. Thank you guys for that. 3.3. So we're seeing inflation at 3.3. It's down from its high points, but it's still far from 2. So inflation's still an issue, yes. But if you get inflation, if you get unemployment to accelerate higher, not only are you going to have inflation come down dramatically, but it could actually go very bad, right? If you get a huge skyrocket in unemployment, which doesn't sound likely when you're at 4%, but what if the direction picks up speed? What if we see this? And if that happens, it's ugly, right? So something to think about is, I think that the Fed is now I think Jerome Powell is properly acknowledging that you have risks on both sides, and everyone knows that. But this is the first time we've really seen, in my view, Jerome Powell just straight up saying it's an equal risk. That's very different than where we were, a year ago. Change your hairstyle. There, I just changed it. Boom. Unfortunately, I say this often. The hair changes when the wife wants it to. But until then, it's here to stay. Yeah. At the end of the day, come on. Wife makes the call on that. Dude, you're my CNBC, Forex Factory, Wall Street Journal, etc. You're doing an amazing job spreading the info. Thank you very much. Again, if you appreciate the content, it is free. Just hit the thumbs up button on the stream. And if you love this stuff as much as I do, it is fascinating to try and study the economy. But I certainly don't know everything. I'm certainly learning myself. There's always more to learn with this stuff. I was learning some more stuff yesterday about the kind of capital markets side of finance, like IPOs and mergers and acquisitions, and whether or not I want to buy financial companies that are in that space. If we see, based on what we see, like if you see an economy where you have inflation cooling, but the economy stays in there, maybe capital markets are an interesting spot, like Goldman Sachs, like companies that could really benefit from bringing, IPOs and, the NASDAQ exchange, these sorts of companies that benefit from capital, stuff. Where's Luna? Tim, I'm at the office. So when I'm at home, Luna's at home with me, but we've got a studio office in Atlanta, Georgia, and our team is right outside that door, and we are in an office. So my studio setup is not at home. My setup at home is really lacking, to be completely honest. Actually, I don't really have a setup at home. Maybe in the future, I will definitely build a studio at home as well. But yeah. What's your wife's name, Nick? MK, Mary Catherine. Okay, so let's get into some charts. I apologize for the very long fundamental macro overhaul this morning. Hopefully it was helpful to you guys. I do that for my own, when I give these presentations each morning, it's really beneficial to myself because I can think through logically what I want to do, in the markets. So I'll tell you where I am positioned. That is what I like to do is, kind of just walk through like my current trades, my current things that I'm looking at in the market, potentially adding, subtracting, new trades, etc. But I will take a moment to just mention while I'm on the subject, if you're somebody who likes the process of economic data, but you'd like to get more in-depth understanding of it, I'd encourage you to join our Discord channel. If you guys are not already in our Discord, maybe we can drop the application link in the chat here for anybody who would like to join Discord. But if you're serious about this stuff and you'd like to come see the trades that I'm taking as well as Frank is taking, we share all of our trades inside of our Discord channel. And I'll mention that here and I'll show you what it looks like. So inside of the group, you can see every trade being taken day in, day out. My winners, my losers, not always right. In fact, if you ask the haters, sometimes I'm really wrong. And, I'm not here saying to the contrary. Sometimes I am wrong. But if you'd like to get every trade alert sent to you, you can join our Discord channel. The VIP room will get you access to, trades that we're taking. Frank and I share all of our stuff in there. So if you're not already in there, make sure, take a second. You can join the free version by applying using that link there. Okay, so anyways, let's go through some positions. I'm still long technology, XLK. I think that, I do want to continue to stay bullish in this market until something shows to the contrary. But in terms of my allocation, this is a chunk of my account is long tech. It's the only sector that I currently have. But then I also have my gold stuff, which I've talked about a lot. Gold is doing pretty well today, up 0.7%. So we'll take that. Gold is up decently well. I'm long silver as well. So I'm long silver, gold. There's several reasons for the gold trade. The basic idea, though, is, there's the softer side, which is like the geopolitical tensions that may go on in the world, but I don't base my entire, trades based on that, because I don't know when that's going to happen. And by the time it does happen, the price is already up tremendously. So that's just a brewing under the surface kind of idea. Is you have tensions in the Middle East, in Eastern Europe, and in Southeast Asia. So you have all these different tensions that could flare up, but I'm not trying to make a call as to when that happens. Generally speaking, it could happen at any point. Something could happen, right? Something could escalate. And so that's sort of a hedge there. But on the other side, the economic data, which I've pointed out, where I'm pointing out that I think, unemployment being on the rise, rate cuts still on the table this year, could lead to gold performing well. It's also an election year, so there's a lot of uncertainty on that front. But from the data, let's talk just data for a second. The EDGEFINDER is giving us a bullish reading on gold. Actually, it's getting a very bullish reading, and we can walk through this for a second. Let's break this down just momentarily. So if I look at gold and I say, look, it's getting a very bullish reading, but why? Let's understand why. Seasonally, can we break that down? Why is it seasonally bullish right now? Let's go to the data scanner and let's understand gold a little bit better here. Gold on a seasonality basis, on the last 10-year historical average, it sees a 0.36% gain in the month of July. So it's a positive expected month for gold this month. Okay, that's one indicator. And what I want to encourage new traders who are listening to think about is a lot of times people overhype one specific indicator, right? Whether it be a technical indicator like a MACD or moving average, or they overemphasize one fundamental one, like they'll only look at seasonality, or they'll only look at GDP, or they'll only look at COT data, right? What I would encourage you to understand is we've added all these different metrics for a reason. They all have some caliber, some level, or even weighting to why we track them. So trend clearly is to the upside for gold. We've seen a nice move in the last week. So trend is up. GDP has come in. Actually, where's GDP? GDP current compared to forecast right here. So GDP forecast was for 1.3 in the latest. We saw a slightly stronger beat. So that's not particularly good for gold. So we'll take a point off. But then if we take a look at manufacturing PMI numbers, right? Here's where things start getting real bullish. Manufacturing PMIs came in less than expected. And so did services, by the way. So manufacturing and services are showing some slowdown. Give gold some kudos for that. Because again, slowing economic data, we take that in the EDGEFINDER's calculations as more of a bullish reading, as people may seek a safe haven outlet on a slowing economy. Okay, let's keep going. Retail sales falls under the same category. It's under the economic growth section for a reason. Retail sales data has come in weaker than expected. So we expected 0.1%. We saw retail sales. Retail sales. Let me just pull up the full chart so I can show it. It's a little easier that way. Hold on. So if I go economic growth and I go to retail sales were expected to be 0.3%. They came in at 0.1%. So again, you can kind of see how we're scoring. We're seeing the data, we're looking through it, and we're saying things that are bullish, things that are bearish, give us score points in each way. And right now, the lean for gold remains very bullish. Okay. Was that helpful? I don't know if you guys want me to do more of that sort of thing. So if that was helpful to you, if you like the breakdowns, like piece by piece economic data on a specific symbol like gold, if that was helpful to you, make sure to hit the thumbs up button on the stream and just real quick, type yes in the chat. That is another way I can visually just see that that made sense. In just 3 minutes, we'll be shifting to our next portion of the show with Nick Phillips. Should be interesting to see what he's got going on as we go into another day with Jerome Powell in just about 15, 20 minutes. We'll hear from him again. So thank you guys for the feedback. We dropped another link here in the chat. If you guys would like to join the free Telegram channel, it is actually free to join. Make sure to do so. If you have not joined the Telegram channel, we put out stuff like that, breakdowns. Myself and my team, Frank, myself, Julie, we manage the Telegram to keep traders informed. So if you have a Telegram, 100%, we'll drop that link one more time if you guys don't mind. Join the free Telegram. It is some free knowledge for you. Yeah, so that's why I'm bullish on gold, and I have a position. I've stayed long, and I've got my stop trailed. We came really close to trailing out of this trade. I would have, taken profits on it if it had closed, but underneath this level. But we bounced back, and so far price action is looking pretty strong. So if we could take out these highs, then that would be great. I'd probably tighten my stop up just a little bit, but I'm looking to see if we can get that push back to the all-time nominal high. And I've said that I say the word nominal for a very specific reason. Nominal high is different than the actual all-time inflation adjusted high. The actual inflation adjusted high for gold is like 30, it's in the 3000s back in like the 80s, and back in 2011, I think the adjusted for inflation price of gold was like 2500. So I think gold has upside. That's where I'm thinking a lot of times people are like, oh, it's at an all-time high. But is it really? It's not actually in a value perspective. It is not at an all-time high. It's got room to continue, in my opinion, especially with all the pent-up energy we have in an election year, not just US elections, UK, EU, changing of leadership in other places like the Labour Party in the UK. It's an interesting year. And so, with rate cuts mixed in there too, I like the upside for gold more than the downside. And if I'm wrong, I'll stop out. Okay, last thing I'll say before we go to a quick break is if you guys would like to try out this tool for 30 days, we'll drop the link here in the chat. We do have a 30-day EDGEFINDER trial available. If you would like to take advantage of that, that link is being dropped in the chat. So take advantage there. Click that link. You get 30 days when you fill out that application. Once you fill that out, we'll send you the information and requirements for that 30-day trial period. So there you go. Okay, guys, real quick break, and then we will be right back with Nick Phillips to see what he's looking at in the markets ahead of JP speaking again up on Capitol Hill. Stay tuned. We'll be right back. We often get asked by our US, how do you guys trade gold and indices on a regulated broker? To trade gold, indices, and more, we trade using Webull. And for US citizens watching now, for a limited time, you can get free stocks if you use our promo link that can be found in the description or dropped in the live chat right now. Webull is our top pick and personal choice when selecting a broker here in the United States for stocks, indices, and commodity trading specifically. Get your free stocks now by clicking the link and signing up using the instructions found there. Now, back to the show. All right, and we're back with Nick Phillips. What's up, man? How you doing?
Hey, what's going on, man? How you doing?
Good. Good to have you back on the show and taking a look at markets ahead of the return of Powell. He was here yesterday. He's back again today. Should be interesting to see what he has to say. I saw you commented something. Was it about the Bank of England or something on the chat here?
Yeah.
What are you looking at today?
So I'm not necessarily trading those comments. I was looking for BOE pill to be a bit more dovish. Pound is, for me personally, it's a little strong compared to what I was anticipating for this currency. So I was hoping he was going to come out today and just lean a little bit more dovish than he is. So I'm staying out. But there were people asking in the comments about, why is the pound going super strong right now? And so I just jumped in there and let everybody know that it was from these comments here, which I think it was this one specifically. Services price inflation and wage growth continue to point to an uncomfortable strength in underlying inflation dynamics. So still some concern about inflation out of the Bank of England. And I'm not willing to trade it higher off of that, but the market obviously is taking it up from there.
Gotcha. Yeah, and as you mentioned, the pound is really making a push up to this this key level on the daily. This is the all-time, or not all-time, the 2024 closing high, right around 1.2850. So off of a daily chart level, we're flirting with here. We're testing out a really key spot on this chart to see, if it's going to break or if it's going to kind of reject. Yesterday, you had some pretty sharp rejection from this level. But I guess,
Right.
we'll have to wait and see on a daily chart perspective, like where this thing is going to want to close. Like, are we going to close with a long wick on the top again today, or are we going to close above this level, which could signal, buyers are really strong here?
Yeah, it would. It's definitely at a very pivotal point here. I think, like I said, I'm pretty dovish on the pound. I, you know, overall, not just because we're at these highs, but some of the underlying economics going on with England right now have me relatively dovish, and I don't really see any reason for the strength that we've gotten over the last couple weeks. It's really, it's not making much sense to me on a fundamental standpoint, other than maybe the services price inflation and wage growth. Other than that, everything else leans kind of dovish, in my opinion.
Yeah, it's a tricky one because it's like if you look at, let's try this out, Euro GBP. If we take a look at the euro against the pound, yeah, there's a lot of pound strength here against not just the US dollar. Here's the pound yen. I mean, look at that chart. My goodness, that has been look at how regimented that upward trend has been. That is really, really crazy. If you take a look at pound Aussie dollar, it's a little bit more mixed because the Australian dollar has been strong. But what about pound Kiwi? Look at that. I mean, pound pairs definitely seeing a big punch to the upside here today. I don't really know what's going on either. I don't follow it nearly as close as I do, U.S. economic data. But I think partially, most currencies are seeing a little bit of a give back with the weaker dollar recently. But, the pound seems to be really strong, even relative to its other peers, as we just walked through. So I don't know, kind of an interesting one to watch that. Did you have any thoughts, Nick, on the dollar here recently? I know Powell yesterday he came out pretty dovish. He came out kind of swinging, saying, now unemployment is equally as important to them to watch as inflation. That was one of the big takeaways from yesterday's hearing. Did you have any thoughts on the dollar right now?
Oh yeah. So for me, I'm seeing Powell yesterday mostly being data dependent. Um, let's see, let me pull this up real quick for you. So in my private community yesterday, I sent them this statement that when Powell presented yesterday, he's also presenting today. The original testimony, as you probably know, is not going to change, right?
Mm,
So this, I always go to the sort of the some of the last paragraphs in some of these things. A lot of these statements from either Powell or just the Fed in general to try to find their forward guidance. I tend to find their forward guidance is in the last 3 to 5 paragraphs somewhere. So I sent this to the group. We continue to make decisions meeting by meeting. We know that reducing policy restraint too soon or too much could stall or even reverse the progress we have seen on inflation. So that's kind of hawkish. They don't want to reduce it too soon. But then you skip another sentence here and you go, reducing policy restraint too late or too little could unduly weaken economic activity and employment. So there's dovish. In considering adjustments to the target range for the federal funds rate, the committee will continue its practice of carefully assessing incoming data and their implications for the evolving outlook. So, going into this meeting, I kind of had an idea, or I figured that we were going to be data dependent from Jerome Powell. We haven't gotten too much data that would, I think, push him to the point where he would go, yeah, we're highly considering rate cuts moving forward. It's,
yep.
it sort of going into it. Like I said, my idea was they're going to kick the can down the road a little bit. He's going to say, we're waiting for more data. We need more inflation data. And that's, not just beyond his testimony. In his Q&A, he reiterated a bunch of statements about waiting for inflation data. Inflation remains above 2% goal. I have some of these highlighted, but not all of them. Let's see. So some of the things he said, well aware that risks are two-sided. Job creation is narrowing in the economy, so there's some weakening in the labor market. We need good inflation data to cut rates. He said that. The last couple of readings show labor market has cooled considerably. We're keeping a close eye on labor market. If we see unexpected weakening, there would there, we would respond. Now, he's been saying that since about April. In April, he started mentioning something that was really key for us, the way that I trade with my private group. We trade the data releases.
Mm-hmm.
So typically, under normal circumstances, we would trade a strong labor data print with dollar upside. But in April, he specifically said continued strength in the labor market would not be a reason for us to adjust monetary policy, right? Okay.
Sure.
So if we get strong labor data, monetary policy isn't affected. I can't have a definable edge in my trades that way. But he then continued on the same foot to say, if we get significant weakening in the labor market, that would be a signal. His words were, that would be a signal for us.
Yeah.
So
exactly.
since April, we've been taking, anytime we've gotten weak labor data, we've been taking dollar downside. But we haven't been trading the same way with strong labor data. Now, I'm interested to see how strong labor data will affect us moving forward, because we are starting to see some downside in the dollar over the last, since the beginning of July. We've started to kind of head to the downside. So sort of starting to get that dollar weakness that I've been waiting on for forever. And Jay Powell, I would say he was data dependent, but leaned dovish. He said rate hikes are unlikely, right? Let me see if I have that written down. So I don't want to misquote him, but I believe his exact words were, we don't take anything off the table. I'm paraphrasing, not exact words, I should say. We're not taking anything off the table, but the next move is most likely not a hike.
Yeah, right. And that's the thing is, I think you look at what he said yesterday in terms of a redirecting the dual mandate kind of concept of, like, it's not just about the inflation side, it's also about the labor side. I mean, that could be taken pretty dovish. I think that was the takeaway. Like you're saying, it was more on the dovish side. It seemed, he leaned into the 2.6% inflation reading on PCE. And I think that, his mention of substantial progress on inflation over the last year, I think people are happy to hear that. The next battleground, I think, though, and when you talk about the dollar index, you talk about dollar strength or weakness, is this labor data and whether or not it is going to continue to accelerate. And, if we see, we're in July right now. If we go into September, and that's when the first real debate for a rate cut seems to be, is like, are we going to get a rate cut in September? Well, between now and then, the data is going to be so important, because if we get 4.2, 4.3, you're going to start seeing increased worries about the other side falling apart, right? Inflation is one side. The other side is the labor data. And if that labor data, which has been trending higher, continues to be, and unemployment rate continues to trend higher, which is not a good thing. If that persists, I think the Fed will lean more and more weighting to that side of the mandate. I was making the point earlier in the live stream that, when inflation was rocketing higher, all eyes, all attention of the Fed went to, let's get inflation under control. And so if you get the other side of the mandate, even if inflation is not at 2% or seriously trending lower, if you see unemployment rates start really accelerating, that also could get their attention. And he's made that point himself. So it will be interesting to see. I mean, we've got inflation this week. We've got CPI reports and PPI reports coming out on Thursday and Friday, both of which will be very important to the market, whether or not we're going to get those September rate cuts or if we're going to push them back. But as you've mentioned, what's important that he mentioned was the next move is likely a cut, not a hike. And that I think for a lot of the market is good enough. Like, a lot of the stock market just said, okay, next move is still a cut. Who cares? We're still going higher. Don't know when it's going to be, but businesses can kind of look forward to cuts, as long as you don't get the other side falling apart, as long as you don't get unemployment and the consumer hurting much longer. But I think that the last thing I'll say too, Nick, is that there's some areas of the economy that are more sensitive or less sensitive to when we get those cuts. We need to start for like restaurants and consumer discretionary companies and things like that. They need to see rate cuts sooner because the consumer is feeling the pain of higher prices. So they need to see rate cuts sooner so we can start seeing, some of that tension relieved for them. But then you have companies like Nvidia who really don't care what interest rates are doing. They really don't seem to be impacted by it. You know what I mean?
Right. Absolutely. Absolutely. I'll say on the unemployment rate, what's interesting about this last print, we got 4.1, I believe, correct?
Yes.
Yes.
One.
So the interesting thing about that, if I can pull this back up. So this is the summary of economic projections that was released in June. Year-end unemployment projection was 4.0 from the Fed.
Yep.
So we have already surpassed
It's a good point.
their year-end projection. And if we hit 4.2 on one of these, upcoming prints before September, I mean, you're talking about their 18-month projection here. They're talking about year-end 2025 being at 4.2. If we hit that now,
Yep. That's a good point.
that I think the markets are going to start pricing in significant dollar weakness off of that.
Because that's a surprise to their forecast. That's a good point. Because if they're
Right.
surprising themselves now, they might, surprise is more urgent than something that's kind of seeing progress. Like inflation, even if it's mild and slow progress, at least they're seeing progress in it. But if they see a surprise in unemployment and a trend higher forming, that is perhaps arguably becoming more and more urgent each time. So we'll see. We've got Powell speaking here today. I believe that is starting soon. So I won't make you stick around, Nick, to listen to the old man speak. But I want to thank you for coming on the show and helping us out, giving us some thoughts here on what you're looking at. It was a really great conversation, I think. And for anybody who is listening and enjoyed hearing Nick's thoughts on stuff, he's got his own group. He's got his own social medias. We'll drop the link here to where you can find Nick on Instagram. You can send him a DM, hit him up, say hello, let him know you saw him on the show, and definitely just go give him a follow at the very least. So Nick, thank you very much for coming on the show, and we'll see you next time, man.
All right. Thank you guys. Have a good one.
All right. See ya. Always good to have Nick on again. It's the Nick Squared show. Really. He's got some great insights. So I believe we have Powell coming through again here today, and then we will see what we get out of it. I think similar to yesterday, I've got to hop off in 15 minutes for a call, but Chris is going to pick up the show, and he may not watch the speech, but I'll at least watch some of it with you guys. Should be interesting. Again, we've got it pulled up. The producer behind the scenes will set it up for us once it's ready, but we are not currently yet live. Gold ahead of the event continues to trend higher. You got the NASDAQ higher, S&P higher, Russell even a little bit higher today. Dollar index slightly lower on the day. Oil is down for the last few days here. Energy is an interesting one. Like, it's more of a defensive sector. I tried to take a long on energy. I took a small loss on it. Will I try again? I'd like to see some momentum pick up for this one, but I am watching energy, XLE, energy companies. I also do kind of like healthcare, but I don't love the chart yet. More of the defensive sectors are on my radar, but on a sector basis, I'm still only long XLK. The Qs are up today. Nice. NASDAQ. Silver's up 1%. This is another trade that's been going pretty well for me. SLV. It's really come back from the dead, I should say. I was so early to this idea. My initial entry was wrong, but my initial stop loss placement was what kept me in the trade. So I took a long on silver here, and price came down and just narrowly missed my stop loss and has bounced back. So I was super early to this idea. Not my best entry on gold or silver, but the stop loss placement kept me in the trade. So it's almost like sometimes my entries are awful, but the stop loss placement saved me in this case. USD CHF, this is a trade that I'm in, has come back against me a little bit. I'm still short on USD CHF from this level here with the stop above the highs. I haven't moved my stop, but I may trim it. I may just take it. In fact, I'm going to, after the stream, I'll do that. Marking that down. If I make any changes or add any new positions, remember you guys will always see them in the Discord channel. You can drop the link one more time for that. If you guys would like to join the Discord, click this link here being dropped in the chat. You can also find it in the description of the live stream, and you can apply to join our Discord channel. Still waiting on JP. We have not seen any feed come through just yet, but we've got it pulled up on the sideline, so stay tuned. It is literally weird as the correlation is not there anymore for UJ. I'm not sure what you mean in terms of correlation. And if there's a breakdown in the correlation, it's probably the yen. The yen has been falling apart recently. Most currencies are really strong against the yen right now because they're just really, really struggling to get their currency under control. They're struggling with growth. In fact, can we look at economic data, GDP? Do we have Japan? Let's look. I mean, there's your problem. Look at this. The Japanese economy. You wonder why the yen is weak. GDP growth has consistently been just poor, just not good. Is that reflective in services PMI as well for Japan? Services PMI was hot, come down a little bit recently. Manufacturing for Japan, it's at 50. It's really that GDP overall, the GDP growth out of Japan being negative and being just not very exciting. Even in peak 2023, 1.5%. I mean, that right there is why I struggle with the yen. Unless you see some sort of significant risk-off event. Oh, sorry, my headlights came on. Hold on, guys. I'm going to turn off my headlight 1 sec. So unless you get some sort of oh, we've got a feed here, guys. We're going to switch over and take a look at that.
We like creative titles here, and that is our traditional title for Humphrey Hawkins. Without objection, all members will have 5 legislative days within which to submit extraneous material to the chair for inclusion in the record. I'll note at the outset this hearing has a hard stop at 1 p.m., which
I don't
we will
trade
strictly observe,
liquidity sweeps.
which seems only humane. I'll now recognize myself for 4 minutes for an opening statement. Thank you, Chair Powell, for being back with us today. With prices increasing more than 20% since President Biden took office, inflation remains top of mind for American families. In fact, only a quarter of Americans describe current economic conditions as good or excellent, according to the most recent data from Gallup's Economic Confidence Index. Despite President Biden's gaslighting, inflation was not 9% when he took office. It was out of control. The out of control inflation we're experiencing now is something that this administration did not inherit, but is a product of their policies and their overspending. The nearly $2 trillion partisan and fiscally reckless spending as a part of the American Rescue Plan poured fuel on a smoldering inflationary fire. After a delayed response to runaway inflation, the FOMC has acted with a historic pace of interest rate hikes to ease the pain caused by Democrats' failed economic policies. It is a response not the actual disease, but the response the Fed is trying to tame these flames, but it's a response to Democrat policies here on Capitol Hill in the administration. So far this year, inflation has been more persistent than many, including the Fed, previously expected. There's still work to be done to reach the Fed's 2% target. As I've repeatedly said, the Fed's, as I repeatedly said, the commitment to independence of the Federal Reserve is of utmost importance, and it is critical, especially in a political year like this. Just as, Chair Powell, just as you did in previous administrations, you must not allow politics to cloud the Fed's monetary policy. However, despite your best efforts, the Fed independence remains at risk. And unfortunately, calls are coming from inside the building. Under Vice Chair Barr, the Fed's regulatory and supervisory agenda has become politicized. Most notably, the development of the Basel III endgame proposal has been a mess. This process has been cloaked in opaque standards and timelines set at meetings of unaccountable global governance bodies. The Fed has promised to process 410 almost universally negative comments, public comments, regarding the unjustified and underutilized initial proposal, or an underanalyzed initial proposal. Recent press reports, which seem to be the only way Congress gets details on the Basel III endgame progress, and your comments yesterday indicate the Fed will finally conduct a long overdue quantitative impact study. That is welcome. And if true, this is a promising development. Chair Powell, the last time you testified before this committee, you stated that the initial Basel III endgame proposal will undergo, quote, broad and material changes, end quote. Yesterday in the Senate, you said the board supports reissuing the updated proposal for public comment. I'm concerned that press reports also claim the Fed will tuck any changes to the proposal into this quantitative impact study. That study, including the substantial changes to the proposal, would then be issued for public feedback with relatively paltry comment period. I'll reiterate to you here what I've said to you in private. Broad and material changes to the Basel III endgame necessitate a full reproposal, full stop, full stop. Failure to do so will result in an immediate Congressional Review Act vote out of this House of Representatives as quickly as we can possibly process it. Now, it doesn't have to be this way, and I think the Fed adhering to its longstanding principles here is highly important, especially with this interagency process. I'll close with this. Your steady and capable apolitical leadership of the Federal Reserve has shepherded our economy through extreme uncertainty. We now find ourselves in the midst of a new type of uncertainty surrounding the leadership of our nation. Doubts, fears, and panic often lead to bad decision-making and even worse policy. I urge you to reject outside political pressure in this volatile time and stay the course for the good of the American people and our economy as a whole. Thank you for your service, and I yield back. I'll now recognize the ranking member of the full committee, Ms. Waters.
Thank you very much, Mr. Chairman. Welcome back to the Honorable Jerome H. Powell, Chairman, Board of Governors of the Federal Reserve System. Chair Powell, as we saw with the latest jobs report, the labor market remains strong and the economy is surging. Despite inheriting an economy from the prior administration that had the worst jobs record since the Great Depression, President Biden has now overseen a record 15.7 million jobs created since he took office, with 206,000 new jobs created just last month. Not only that, but under the Biden administration, we're witnessing low unemployment rates, rising wages, and stabilizing prices for goods and services. This is not only because of President Biden's strong leadership, but also because of the historic legislation signed into law by President Biden, which has resulted in lower costs, created more jobs, rebuilt our infrastructure, supported small businesses, eliminated mostly junk fees, wiped out more than 100 $144 billion in federal student loan debt for 14 million borrowers and cut child poverty in half. President Biden is and will continue to advance policies that are providing good paying jobs and an economy that works for everyone. Now, while I'm pleased to see that inflation is declining, the latest data makes clear that housing remains the #1 driver of core inflation. Since 2020, house prices have increased by nearly 50%, with Americans now spending on average over 30% of their income on housing. This is a top priority for Democrats, but remains an afterthought for Republicans. Earlier this Congress, I reintroduced my comprehensive legislation housing package, including the Housing Crisis Response Act. This bill provides more than $150 billion in fair and affordable housing investments, representing the single largest investment.
Okay, guys, I'm going to bring in, actually, producers, if you guys could just bring in Chris really quick. I'm going to have to hand off the show to Chris. I've got this call with Eightcap if he's cool with it. Say hello to Chris here in just a second. Hey, Chris, what's going on, man?
What's up, Nick?
Hey, sorry to just drop the stream on you. Got 800 people to take care of really quick. I've got this call with Eightcap at 10:15. So feel free to lead however you want. If you want to watch more of the show, just let James and Chandler know. They'll or more of the, I guess it is a show, the hearing here. Up to you what you'd like to do, but you got it for a little bit, and I'll ask Frank to join you soon as well.
Sounds good. Yeah, I'm good with, you can cut the stream. I don't care what Miss Waters has to say or anybody else. Yeah, let's watch some price action.
Okay, sounds good. All right, enjoy it. I'll see you next time.
All right, thanks, Nick. All right, everybody. Happy Wednesday. I was just taking a look at some Bitcoin and Ethereum futures, looking at a trade here in micro Ethereum. I can show, well, already. So before I started the session today, I did the SPX trade, which is just kind of my daily take, watching a couple of things. And here's my 0 DTE. It already shows. So this is, price has gone up a little bit. I centered this around like 55.85. This was trading around 225 earlier, was down as low as $1.80, $1.75, which was enough to get my 15% take profit. This trade is done. I've already noted it. I centered around 55.85. I did a synthetic strangle 56.10 by 55.65, 225 credit. I was looking for a debit of $1.90, grabbed my 35-cent win. That was by 10 a.m. I actually had the trade in profit by 9:59. So the rest of the day doesn't really matter. That trade is done. But obviously when it comes to price action, the market has made highs, highs, highs. This is now 3 new all-time highs in the S&P. You know, as traders, we look at this, it's like the headlines will be all-time highs, all-time highs. And I look at this as, oh, okay, I mean, you're just inching higher. It does give a little concern. You know, we have big data tomorrow. Okay. Data that I'm watching very closely. This is real-time levels on my SPY. I was considering, and I could still take this trade. It's going to be a bit more expensive to do it now. But if I were to take I don't know, I'll walk through it. This is showing a gamma level at the current net positioning is 1474, which I had said yesterday in my trading room. Anytime that I start to see a 1500 or higher in my current net, that just essentially it's kind of like open interest. It means there's some activity around that particular price point. You know, we opened at it already. If there's going to be a directional day today on Wednesday, maybe the market drifts a little bit higher. But you can see that there's very little activity to the upside. Oops, change the color here. There's very little activity to the upside or downside as far as, you know, gamma squeeze levels. So the market doesn't necessarily have a plan today as far as going somewhere, right? The plan was, let's get to 557. Well, we opened at it. So that plan is done. We have CPI tomorrow, which comes at 8:30. These levels are going to move, and I'm curious if I can get some type of, you know, 0 to 1 DTE trade for the SPY. Maybe 560 is the number. I was hoping that by, maybe later today, like 560 kind of lights up and shows some open interest in gamma squeeze levels for tomorrow, or to the downside, something lights up to the downside. So I'm very, data dependent here. I'm very visually dependent on what I see on these gamma levels before I place any type of short-term trade. Otherwise, it's been Monday win, Tuesday win, and Wednesday win, just on the same little like synthetic strangle. I want to go into Ethereum futures for a moment. We're holding this level pretty nicely around 2,800. And so I want to show you a couple things on this chart. So if I go Ethereum future, which is /ETH, if I did I was looking at a credit spread here, a 2,800 by 2,700 credit spread. It's a good trade, but I'm risking about 2 times as much as what I would gain. I think that's a little bit heavy on the risk side. I do like the trade, but I want to tighten up that risk quite a bit. So I'm going to take a look here for micro Ethereum, which should be micro ET, MET. And if I went out the same duration, 28 by 27, now it's a 66 by 3350. Now I can go contract sizes here. If I did one contract, I risk $6.65. I mean, it's crazy. Like it's 1,000 points different essentially. So, I mean, am I going to do a 50 contract micro Ethereum trade? I could do 30 contracts and, risk $2 to make $100. Considering it's, $3,000 risk versus $1,000 or, 200 for 100, that's not a bad trade if I can get filled on this. The only issue that I see here is look at how wide the spread is. So this is showing a bid of 1750, a mid of 3350, and an ask of 48. That's a very wide spread. We're already 100 points out. If I'm going to get filled on this, I'm not taking anything less than the mid at 3350. So that'll help me define my risk. If I did, let's do 50 contracts here. So 50 contracts is 167 by 332. It's only going to type about $626 of buying power. So I think I'm going to take this trade. I'm going out 51 days. Couple of things, right? We have inflation data coming tomorrow. And I mentioned this in my trading this morning. From tomorrow's news, testimony today with Powell. If you want to watch it, great. I don't. Price clearly is not really doing much. Powell is very crafty on how he talks into the microphone. When he's at the podium, he is a wordsmith. He can say things that the market can't quite discern. Is this hawkish? Is this dovish? I think it's hawkish. I think it's dovish. And sometimes he delivers incredible, movers, but for the most part, his narrative has been so consistent for the last year plus. Look, the market's anticipating a 73% probability that we're going to cut rates in September. We know that, right? That has increased over 20+% in the last couple of weeks. So the market's anticipating a cut, but guess what? The head of the Fed will not give the market the satisfaction to say we're going to cut, right? He won't explicitly say we're going to cut. He keeps towing that line of, well, we don't want to have inflation poke back up. We want to make sure it could be good for the homeowner. It could, we know why it could be good. We see unemployment numbers ticking higher. We see a softening of the labor market. This is all what the Fed has wanted without having to do anything with rates. Now is it to the point where it's too late? I don't know. Is the Fed rate cut cycle and maybe the reason this is somewhat different is this rate cut cycle might be so much more data dependent that it's not just cut, and it's methodically laid out. Although historically, that's what the Fed is known for, right? The Fed usually, when they start a cut cycle, it starts and it doesn't stop until they're satisfied. And so are we cutting from, 5.5% down to 3% over the next couple of years? Maybe. Does something break in the interim with the bond market or the equities market? Do we have to have a cushion somewhere? So anyway, I'm going to take this trade. I'm going to see if I can get filled. Let me see if I can get $35 for this trade. I'm going slightly above the mid price at 50 contracts. Seems a little wide, but anyway, I'm going to see if I can take the trade out for my account. So give me a second here. Expiration cycle is now closing only. Dude, I got all that fixed. Oh my gosh. I literally emailed Tasty's support team and I had that stuff removed. Can I not? All right, fudge it. Well, that just thwarted my trade. Dumb. All right, never mind. Let me go gold futures instead. All right, I'm going to go gold futures and silver futures. I like silver futures better. I'm going to put another position on gold futures, which I have running already, but I'm going to check my expiration. So I have a gold futures trade out to the 27th. I have a couple of credit spreads. Okay, that's good. If we go into, I might go out another month. So if we went into the August 27th, that's 48 days out. I'm going to go to September 25th and look at the same thing on gold futures. If we stay above 2,300, see if we stay above 2,300. So I'm going to put in, my line in the sand is going to be right at 2,300, which is showing here about a 20 delta. And let's do a $5 spread. So that's not bad. I can get 120 bucks, risk 380. That's around a third of the width, which is fine, especially an out of the money credit spread. Do I want to go lower than that? Not necessarily. Let me do, I think I'm going to do 2 contracts here. Okay, this is going to be about a 0.5% risk for me on a lot of these accounts. And if I'm right, income wise, I'm generating about 300 bucks. Let me try to get let me try to get $1.20. $1.20 through September 25th. No assignment. This is just straight up. I win or I lose, but it's only tying up 500 bucks of buying power. That return on capital, by the way, can be pretty solid. If I'm putting up $509 and I'm generating $360 of profit, that's a pretty solid return. Okay, so let me see if I can get filled. So now the mid is $1.10, $1.20. See if I get filled here for $1.20. So $1.20 is not filling. Let's try $1.15. If I can get $1.15, maybe it's increments of zeros. Yep, shoot, I got to go $1.10 or $1.20. $1.10 is below the mid price, which should get filled. $1.10 gives me a 345 profit. I'm going to take that trade. That should be fine. Filled at $1.10. Okay. I'm going to put give me like 30 seconds to get these all my accounts. Okay. 7634. And 2 more fills here, and then I'm good. I'm going to move on to silver futures after this. And 8051. There we go. Okay. So that trade is in. Go to my tracker here. This is a GC. There we go. So GC 925 expiration 2,300 by 2295 $1.10 credit. That is a 345 max profit for a 655 risk. All right, so that trade is in. Jay's asking, you've been in the game for 20 years. Well, because each individual account, look, man, it's about small wins and consistency. You know, if I take a trade, look, here's why. I trade money for other people, right? I've been in this game long enough that I know the sentiments and the emotions of people that I trade for. My job is to make money consistently, where the drawdowns are very manageable, hardly noticeable, and all they see is their account up every month, right? If I'm going to take this huge swing and it's like, look, I'm going to make 10 grand on gold. Cool. What happens if I lose 20 grand? You know, 20 grand to the net portfolio is not a big hit, but to a client, you know, taking $1,000 here, they love it when I make them $1,000. They hate it when I lose them $1,000. And it's funny because I have clients that'll tell me like, just take the risk and I'm fine with it. I'm good with it. I know they're not. And I know that because I've traded through sovereign debt crisis. I've traded through financial crisis. I've traded through Brexit and flash crashes. I've traded through oil crises. I've traded through drawdown, right? I've traded through all that stuff. So why do I take small wins? Because I can take 1,000 of those trades. You know, and literally like I'm taking probably 2,000 to 3,000 trades a year. So let's say, and I did this yesterday in my trading room. I added up my 2024 track record thus far. We have about 71% of our trades have been winners. So let's say that my average winner is $300. Okay. And I'm going to take 1,000 trades. I'm just going to do the numbers. So of 1,000 trades, I have 710 winners. Let's say my winner is $300. Okay. That's making $213,000. Clients are happy. Portfolio is moving. You know, it's okay. I don't look, I'm not a home run trader, you know. Home runs for me are typically, you know, maybe a 3 to 5% move for the entire portfolio, but it's all risk diversified. It's never all eggs in one basket. I don't trade that way. I've never traded that way. I don't think that's the way you make money. So that's all I'm saying. Small wins, consistent wins. No one trade defines me as like, oh my gosh, I can't believe that happened. Look, I can be wrong. I'm wrong in several positions right now. What up, dude? You know, my plays on China are upside down a little bit, but that drawdown has been mitigated. I'm starting to see that China's coming back a little bit in a nice way because this, you know, the market's been inching up higher and I've been pretty flat on my day-to-day P&L, but the last 3 days, this has been really nice. So, I mean, currently up around 12 grand today. P&L's back up to nearly 100 grand. And here we go, you know, so hope that helps. That's my answer. You know, it's not about big wins. It's not about big losses. It's just consistency and lots of samples. And, you know, I say process equals profits. It adds up, right? Accumulation is nice. Okay. So that's gold futures. I'm going to go SI. This is silver futures right now. I'm looking at a similar trade. Silver to me also looks postured pretty solid. I have September and August expiration. So I may not add another position on silver futures because these are looking pretty solid. 26.25 and 26.25 all the way down here with different expirations. However, I might take a slightly closer at the money, $28. Let me see if that looks good on silver. So here's silver. And so we have silver, which is SI, or you can do silver micro, which would be SIL. Yep. So if you have a small account, no options available for micro. Interesting. Okay. So SI, this would be my futures options trades. Okay. So if I went out 48 days and I go to that $28, this is now a 12 delta. So there's another one. Okay. So, you know, I make 160 to risk 1,100. That I don't love. That's a little bit backwards. I'm collecting less than, you know, if I'm doing especially an out of the money credit spread, I'd like to collect about 25 to 35% of the width. If I'm closer to the money, I'm trying to go for like 45 to 50% or 50 cents on the dollar. This is way too backwards to have a trade that, you know, and plus, like I said, if I'm going down here, I mean, the probability of this trade right now is about 97%. So there's probably not much that I have to do on this trade outside of just let it go to expiration. This will help me generate probably $600 or $700 per account. And that's fine. So I don't need to get necessarily a little bit tighter on silver. I thought about it, but probably not going to. But instead, I want to look at something on SLV. Okay. SLV, I have some naked puts, and I'm probably going to reissue those. Let me check on those expirations. Are we long or short on gold? I personally am getting long on gold. I like long on gold for me personally. I was going to look at SLV. So there are my puts right there. Generated some nice profit for this account at $5,400 so far for the year. Still looking to build on that. These are July 19th expirations. I want to see another. So it looks like right now I'm curious on my $28. So I did all these puts together for a total of $3.29. If I look to close all these right now, which is a week away, week and a half away from expiration. So for my 329, I can take about 50% of that profit, free up some buying power, and that's great. What I'm noticing is if I go out for another cycle, I mean, I'm only 9 days to expiration. If price is going to rally, that means that on silver, I'm not going to take a single assignment. Okay. Which is kind of unfortunate because I was hoping I could at least have some shares of SLV and still maintain a 100 delta long position in SLV. Now to do that, I want to have shares. All right, I made a lot of money on a call, like it was basically a leap on silver, and it was up 100+% earlier in the year. I turned it into a calendar spread, and I ended up closing the trade out for a nice win. But now I was looking at, okay, let's take the time out of the fact. Let's take time out of it. Let's own some shares of SLV. And, I'm sitting here where we were down, by the way, this pullback was $26. I'm like, well, I guess I might get assigned in all four strike levels. Doesn't seem to be the case right now. So I'm going to do the same type of thing where these are looking pretty good for, maybe my 29 is the only one that's assigned. So let's say that my 29 is assigned. Well, the nice thing is because I still took credit here for $3.29, I get assigned at 29. And how does that happen by next Friday? If price is below $29, I'm getting assigned at $29. Okay, fine. So I'll take 200 shares. Okay, 200 shares at $29. And then I get to subtract my puts, which would be $3.29. Okay. So right there, my break even is going to be 25.71. If I take the shares, even though I'm getting assigned at 29, because I've already generated these cash secured put credits, I actually own SLV. If I'm assigned, I own it at 25.71. It's not a bad spot. Okay. Now, where's my upside? My upside is $32 to $33 is my first measured move. Okay. So if I can take my shares, which would still be 200 shares, and I don't do anything and just sit on it until directionally it hits my price target, that is a, what is that? $6. This would be $6 to $7 of upside on 200 shares. So I'm looking at, somewhere between $1,200 and $1,400 profit. Now, do I want to juice that a little bit? Sure. If I sold a call up here, when price gets close to it, I can also generate another credit. I can lower my cost basis maybe by another 30 to 40 cents, which helps me make another couple $100. But longer term, I like silver a lot over the next 12 to 24 months. Okay. So just my thoughts. So anyway, SLV, I'm willing to take some assignment. I probably will take the assignment at 29. I also may look at let me see if I can go out a little bit further here. So if I go to, by the way, James, and Chandler, if Frank's going to jump on, he can jump on anytime. We'll chat. But I was looking at going out maybe to the end of August and looking to generate a little bit more income on some of these puts. I don't get a ton of credit for them. So I had four puts added up to $3 if I go out. Maybe I have to go a little bit further. Maybe August isn't enough time. If I go to September, let me go to the end of the quarter. It's still not that much better. Yes. 27, 26, 25. I don't really like those. Let me get rid of this. So if I went out to September 30th, which is 82 days to expiration, I did a couple of puts on that. I don't love it. Now let me check one thing. If I do, SI and do silver futures, let me go out to September 25th. I could probably generate, and again, this is going to be totally dependent on buying power. What would be a spot that I would say, where would I like? I mean, I'm not going to own this. I'm just looking to generate income from it. So it's probably better to be more delta specific on this one. If I did a 15 delta, which would be 28, max loss of $138,000 takes up $6,300 of buying power to make $1,300 bucks. That's the trade-off with futures. You have a ton of leverage, but there's no way that I'm taking assignment here. 28 bucks. It's like, that's ridiculous. I would probably go down here towards 20. Let me get the SI feed here. Hang on. Silver futures. Where was that breakout point? That breakout point was 26. Yeah, that's why I put the trade on originally. So let me see if I can go down to 26. So 26.50. Let me do like a 27 by 25. That's just way too much risk. You know, make 500 bucks to risk 10 grand. I'm not taking assignment on silver futures. There's no way. No thanks. So, I mean, I guess I'm positioned on silver futures as I need to be. SLV, unfortunately, I can't get the credit that I want unless I'm going to say, at this point, you know, we're at the halfway point of the year. I'm not really getting the credits I want through September. Maybe I just go out and say, look, I think silver is going to be above X amount by December. So let me see what these look like. Would I be willing to take more shares of SLV if we had a dip in, you know, let's go back to the feed here. All right. Jay says, how'd you deal with the 2008 crisis? How'd you trade? When the market's choppy, I mean, it's not that bad because look, so trading stocks, trading options, futures has been way more incorporated for me the last like 4 or 5 years, way more active income generation with options the last 5, 6 years, zero DT the last 2 years, you know, to incorporate that futures trading, scalping, short-term trades, you know, basically I'll say this. I always have core positions. And then the nice thing about trading options and trading futures around core positions is you can use them to generate profit, generate income, and also lower the cost basis on your core position. Trading around the financial crisis was pretty easy. You can use a collar trade around the SPY, right? If you know, you buy the SPY, have that exposure. I essentially, look, I've been participating in the stock market since 2000. So, I mean, part of it is it's exposure, it's time in the market. And as they say, this is totally true. Time in the market is more important than timing the market. You know, I mean, look, 2001 was chaos in the tech world. We had the NASDAQ down, you know, 80%. We had tech names that you know now that were down 80 to 90% that somehow still survived. 2008, when we finally hit the bottom from peak to trough, was a 56% pull down on an index. How did you get out of it? You had to play defense. You had to be hedged. You had to be collared. You had to be positioned where you can weather the storm in some type of drawdown. On top of that, another way to make a lot of money during a bear market or a crisis, or you know, the market, like the stock market is the toughest one unless you're playing a lot of defense, because when the markets are dropping and tanking right now, I don't believe that the bond market is going to do enough to the upside to take to make traders enough money to cover their losses in equities, right? I mean, if you think about that traditional 60-40 portfolio, 60% of my portfolio in equities, 40% of my portfolio in bonds, I don't adhere to that. I'm more like a 99-1 equities to bonds. I really don't like bonds that much. I literally have like a 2% exposure in bonds right now. It's the TLT, it's longer term. I don't like the bond market. We're in a 3-year drawdown. I think your upside is very limited and capped on bonds. I mean, it's a different scenario now that bonds yields are, you know, 4 to 5% if you hold them to maturity, but they're really, really sensitive to interest rates. And we've been in a wild interest rate environment the last couple of years, obviously. So back to your question on 2008, currency markets helped me protect a lot of my portfolio during a bear market. If we have a bear market, you're playing defense. You're trying to mitigate some of the trouble and some of the drawdowns you might have because everything is dropping in the stock market. You can't catch a bottom in the stock market, right? Look, if we have a bear market, Nvidia, Apple, Microsoft, Google, they're all going to go down, right? Tesla, it's going to go down. There won't be one stock that still rallies, right? You might have defensives that are stable. You might have utilities that are stable, industrials that are stable. Maybe there's a play on aluminum. Maybe there's a spike up in inflation. And so you've got, wheat and soybeans and corn and commodities that maybe start to go up. But that's a very small segment that unless you're super, super into those, and I mean like a high allocation of portfolio, most of the time the market's going to drop. And so you have to be diversified where currencies might be your best friend during a bear market, right? If you want to look back and see what the markets did in 2008, look at the Japanese yen in 2008. Look at what the dollar did in 2008. Currencies with a leverage market, especially in Forex, there's lots of opportunities to make money in a bear market. But if that profit in a currency market is helping mitigate or offsetting some of the drawdowns in your stock market, the thing you can do the best in a downturn in the market is lower your core position cost basis. That is the best thing you can do. Why? Because after we have a 10, 15, 20% cleanse in the market, what have we seen the market do historically for the last century? It finds a way to purge, it finds a way to cleanse, and it finds a way to bottom and stabilize. And then when it's time and it's appropriate, sentiment lifts, things come back up. And if you stay invested and you have the dry powder to buy more, you tend to be rewarded handsomely for that. So when it comes to a bear market in stocks, like I've said this all week, I'm not hedging to make money. Obviously I want to, but I'm hedging to basically say, if here's where I'm at today for all my profits and the market drops 10%, I'm still at the same watermark level. My balances are still the same. That's my job of hedging, right? And that way, if we have a purge and the market cleanses by 5 or 10%, and then we still finish the year at all-time highs, guess what? I held my, I dug my heels in essentially, and I hold my positions, I hold my watermark highs, and then we still gain because we're still investing, right? But the flip side of that is, where do I make money? I can make money in currencies. I can make money in futures. I can make money in short-term trading options. I can make money with protection, but I'm trying to lower my cost basis on my core positions. I don't want them to be, oh crap, now I'm down. And if Nvidia drops 50% from the all-time highs, I don't want to be stuck buying Nvidia at the highs. I want to be lowering my cost basis the entire time. And so maybe I own Nvidia 40% off the highs, and it's actually 50% off the highs. But if we have a response, it goes up, right? So anyway, does that help? So how do I trade it? It's trading currencies, it's trading stocks and options, it's protecting your core positions, it's defensively trading a little bit around them where where your cost basis is at all times, and making sure that you're not necessarily caught off guard. Okay. Key testimony or takeaways from today. Not that I saw Alan when I came on. Nick had the stream up. It's really not Powell that talks. I mean, if he says a couple things, guess how you're going to find it? Read it in a newsletter. I've got, Opening Bell Daily. I've got Stock Twits. I can look on Financial Juice and see if there's any takeaways. But has price really made a big move today? So Powell talking on Capitol Hill today, is it moving the market? Nope. This is what he's great at doing. Nothing. He's talking very carefully both ways. It's data dependent, but the market's already anticipating some type of rate cut coming in September. We have important data tomorrow at 8:30. That's going to be your CPI news. And I promise you this, with a 99% probability, we're probably going to gap tomorrow in a big way. Up or down, I don't know. Okay. We know that the calendar is forecasting 3.1% year over year. Now, I did this morning in my trading room. Truflation is a third-party tool, but Truflation has measured this to say that our inflation index in the U.S. is down below 2% right now. Okay, this shows the year-over-year change at 1.87. The Fed's been talking about sub 2%, under 2%, below 2%. That's our target, 2%. We're about to print 3 point something tomorrow. Now, could the market get excited for a 3.0 or 2.9 or 2.8? Sure, market might be thrilled to see that. Okay, but the market might also hate a 3.2 or 3.3 if we miss. So the data is going to be extremely sensitive coming into tomorrow's trading. Here's the news tomorrow, 8:30 a.m. It's going to rock the futures market initially. We're going to see some gaps in the SPY and gaps in the Qs, for better, for worse. You know, technically, we've been looking at 560 on the SPY, roughly 5,600 on the SPX. And year over year is forecast for 3.1. Now, the previous print was 3.3, forecasting 3.1. We're going to look to see if they are better than that. You know, so would the market, you know, be excited for a 3.1? Maybe, because it's trending lower. Would the market be more excited for a 3.0 or 2.9? Probably. But even though, and I said this yesterday in the stream, even if we printed 2.9, we've actually been there before. We were there. We were there last year. Last summer, we were at 2.9. We haven't improved inflation numbers in over a year. It's been sticky, right? So, I mean, yes, the market might be excited, but realistically, until we start seeing like 2.5s and 2.4s and 2.3s, that's, you know, and it's not just CPI. There's PPI data and there's PCE data, and that's where all of those levels are looking to go at 2% or below 2%, right? I just think it's interesting. However, Trueflation calculates their inflation index, you know, we're being read right now at 1.87, which I think is interesting. You know, I mean, I don't know which is right. It is what it is. It's, you know, it's third party. They do their thing. I don't know what their magic formula is, but it's hard to also, you know, buy into our inflation with the US where we exclude food and energy, which day to day is what most people feel, right? If expenses are more, there he is. If expenses are more, you're feeling it in food and energy. So, Frank, what's up, dude?
What are we talking about today?
We're talking. So I was talking about, so somebody's asking about the testimony, any takeaways. And I just said, well, it's Jerome Powell speaking, and he probably gave a canned statement. And then everyone else is going to talk about, you know, they want their time to shine for the little presser. And price hasn't done anything today. Now, what price has done is opened higher, opened higher, opened higher. We have 3 consecutive days with new all-time highs. I don't like how it feels, but how I feel doesn't matter. I just think that at the end of the day, all the signs are there for a technical correction, but price has yet to support this outlook, right? So I want to show you one thing really quickly, and this goes back to what we've been mentioning. Let's go to, I've got a different workspace here I want to share with everybody. So take a look at this. So some of my evidence is pretty straightforward. On the weekly time frame, I don't see the weekly charts have a lot of overbought conditions. The daily's overbought quite a bit. It's signaled some pretty nice tops and bottoms over the last several years. I mean, this, you can look back, you know, 30 years of price action and see this thing signal some tops and bottoms. But the weekly is what I'm really drawn to. So my weekly time frame, when I see this right here, that called a nice top at the end of 2021. Okay, this called a nice top in the end of 2018 where we had that correction. We're at the same situation right now. Now, you can't see it because it's covered up with some of my trend lines, but there is another connector right here, which is the relative strength index is overbought, and the momentum oscillator is also disagreeing with price. So when price is going up and my momentum is going down, that's divergence. Okay, now I have one more chart I want to share. I built this yesterday, and I just put some kind of tried and true classic indicators on here, but I want to share that with everybody. So we have a MACD right here. We have a relative strength right here, and then I have a Keltner channel with some moving averages. So we are well extended above the Keltner channel, which I'm looking for. And I don't trade both directions. In Forex, I trade both directions with Keltner, but in stocks, I'm looking for it to be support only. And so what I do see pretty easily is you have a high in momentum with the MACD, a high here, and a high here. You notice that those are making lower highs. That's divergence. We also have overbought conditions with price making higher highs and overbought conditions with divergence. And so, as I said, all the technical signs are there for some type of correction to take place. The missing ingredient right now is price action. Price action has not supported a sell-off yet. We haven't broken floors. We haven't broken trend lines. We haven't had any real meaningful bearish day. And Frank, this is what you and I keep talking about. if we don't have price actually moving to the downside, all we're doing is wondering and waiting. Now, I've played protection. I put on some hedges. I'm long the VIX. I've got it all out there through probably end of August, end of September for right now. And I'll reposition for the same thing. If I lose on those little hedge plays, I'll do the same thing through the end of the year. Just because in case it happens, I want to be ready for it. Another thing, just real quickly on the technicals, I'm going to go to the weekly chart here. Let's go weekly chart. And here's another thing with the weekly chart. Okay. From this high to this high, notice we have some hidden bearish divergence on the relative strength, and we're also overbought. Now, let me double check that this is in fact a chart-based time frame. Yep. So this is a weekly time frame, and we're still showing overbought conditions on the weekly. So, okay. Also, one more thing. If I am in any way, shape, or form correct with a wave count, if this is 1, 2, 3, 4, 5. If I've got any traders out there with Elliott wave knowledge, look, I know the fifth wave might stretch a little bit higher. Okay, might stretch a little bit higher, but if and when we take a turn, we're likely looking for a 1, 2, 3 wave correction. And that 3-wave correction pulls back into the top of this or the bottom of this. If I'm going to be a buyer, that's really where I'm looking to resume buying, is going to be somewhere between 520 and 500 on the SPY. If I really want to take like another kind of tranche core position on the SPY, it would be a healthy correction to the downside. Frank, any thoughts?
What makes you think, though? I mean, so we have CPI tomorrow.
Yep.
And Powell, by not saying anything, he's being dovish. He also is saying that if rates stay this high for too long, it's going to be dangerous for the economy. So everyone's still expecting that cut in September. So what I'm wondering is, I understand hedging, but trying to see, I guess what you're trying to look at is that wave pattern, which honestly I don't really know very well, but I'm just guessing, like, if we see more of the same from Powell and CPI, say it doesn't really move or it moves a little lower this month, I feel like this is setting the precedent for the rest of the year, to be honest. So we can expect more of the same. And honestly, yeah, you look at the 5-minute chart, every time you could buy at the close of the day and be profitable at open, which is, I don't know, those call plays are working out, but it just seems like the trend is all more the same. So why would we want to look and try to, I guess, predict where things are going to go and just move where things are going?
So you're saying what? Just to remain blindly bullish?
Almost.
Okay. Well, I'm never going to do that. Here's another reason why. So S&P's up 17% year to date, which is only in the 66th percentile of gains for the S&P. But our drawdown of 5%, 6% is in the 91st percentile, meaning the reward to risk ratio, the risk adjusted ratio this year is way off, right? I mean, if we're going to produce 17% year to date and possibly stretch more, and historically in election years, 20 to 21% is the election year average. So we still have that extra 3, 4, 5% kind of blow off move that maybe hasn't happened yet. And so you're right. Maybe we could be blindly bullish and still benefit. But I think that when the risk adjusted returns are typically always 3 to 1, you have a 30% drawdown for a 10% upside. That's always been the case for a century. Right. So, I mean, for us to have 17% for a 5% drawdown, I'm not comfortable saying I'm blindly bullish. Right. I know that my portfolio is exposed. If this market turns down, I'm exposed. Right. My accounts are too large to have, zero exposure where it's like, if it goes down, it doesn't hurt me. Everything's risk defined. It's not. I mean, I own stocks, I own indexes. And so I have to be protecting those at all costs. And I'm not protecting because I want to waste money on hedging. I'm protecting them because I want to lower my cost basis or my core position if the market drops. And so I'm playing the if, right? I'm not playing the when, I'm playing the if. If we drop, I'm going to be okay, right? Like think of 2022 when the market drops 25 to 35%. I watched traders that I knew, portfolios that you know, students of mine, followers of mine. Look, I was in a 6 to 7% drawdown, 10% drawdown during 2022, but I ended up making money on the year. But I had to play very defensively, and if it wasn't for currencies, I would have had a really rough 2022. But currencies saved me in a big way. Okay, but 2020 that was different because it lasted a month. But if you go into any bear market scenario, like end of 2018, the market dropped 20%. Most people that don't play any type of protection, they're down 20%, if not worse, because the index being down 20%, you're going to have individual stocks that are down double that, right? I mean, case in point would be how many people right now, I mean, Nick has mentioned he's got a friend that's long NVIDIA, that's his biggest position. That's all he's doing is being long NVIDIA. If NVIDIA goes down 50%, what's that trader's portfolio look like?
Yeah, it's going to be down 50%.
Terrible. So, like I'm saying, I'm not playing the I'm playing the if, not the when. Like I'm not calling a top. Look, I would be happier. This market has eked out 3 all-time highs this week. That's it. Okay. But when you say if all you did every single time is just buy at the close and it goes up, it's like, okay, but that's great until it stops working. That's great until we actually go down and go sideways. I mean, did that work for the last 3 weeks? No. I mean, it didn't work this week. It didn't work. It's like, I mean, if that's all you did every single day was buy at the end of the day and see it go up, do you have a stop loss in? Or what happens if the market gaps lower by 0.5% or 1%? You're down. You know, I mean, so I just give me a better plan. Like if you have defined risk where all you're doing is buying a call option and it goes up, that might be good. If you just bought the stock and had a stop loss, that works too. But you got to have something where you can't let the market just, if it goes up, great. That's really freaking easy. But if this market doesn't go up forever, which we know it's not going to, right? At some point, there's going to be a reality check. And I don't know if it's 560. I don't know if it's 600. I don't know if the SPY is going to go up until we have a crack. But you and I both know that there's going to be a crack. Something's going to change. It's going to break the bond market. We're going to cut rates too quickly. Inflation's going to rear up again. We're going to cut rates too slowly. I mean, the Fed, I keep saying this, man, for as long as I've been trading, the saying's been don't fight the Fed. And I get it. But look at what the Fed continues to do. Jerome Powell will not give the market the satisfaction of saying this is when we're going to cut rates. Look, the market's pricing in the 73% probability. It's not Jerome Powell, right? His comments are not dovish, nor are they hawkish. They're the same that they've been for a year. All that they've been doing is nothing. And the market is doing its thing, but job numbers have been softening, labor market's been softening, inflation's been under control, and the Fed has orchestrated a pretty soft or no landing scenario for now. But I don't think this continues to happen. We can't see the market play out this way and think this is a healthy market because it's so concentrated, it's so narrow that you can't tell me you're confident and comfortable that like this market's going to all of a sudden be fully broad-based bull market. If it is, great. That's how we survive another rally. But if this
Chris, I was testing you. Just because the last month or so when we've gone on, I've been talking about this correction, but I want to see your reaction just because, there isn't much more to say at this point. I just think it's going to be more of the same, but it's always good to be prepared for that one instance where it can all turn around. Like from 2020 to 21, we saw a huge uptrend. That was like a year and a half of nothing but buying. And then one day it just gets struck down. So, I mean, we honestly could have a lot of room left for the S&P, at least. The tech bubble can still run. The AI trade can still run.
Yep.
So up until then, I mean, I guess I was half joking. It is kind of more the same. We'll have a week where it's in the red, but the next week we'll blow out last week's losses. We'll hit new all-time highs. So things like that, I think it's good to stay long if you
Yep.
are.
Yep.
But yeah, at this point, it's like, well, what are we gonna do like when things go south? And CPI could be that mover. We could see a CPI come in hotter, and that would be extremely bad. And then Powell will all of a sudden seem more hawkish, even though he's going to say the same thing.
It's true.
So I guess until then, we've seen 6 months of CPI and NFP. Regardless of that trend, look where the market has gone. So what
Yeah.
will have to change, I guess, is going to come from the Fed. But if Powell is not changing what he's saying, then it might not be a big factor. CPI will definitely cause an initial reaction, but in a week from then, where's it going to be? Most likely higher if CPI is, say, it's lower or unchanged.
Yeah.
I think the
If it's in
market's
line, yeah, I think since we're forecasting an inline CPI of 3.1, that is showing that the trend is lower. And one thing Powell has mentioned on inflation is that it's trending lower. It's trending lower. It's like when we were at 9% and we've trended lower. We had a great recovery back down to 2.9, then reared up again, then back. So I think as long as they look at this as this is trending lower, it's going to be maybe the slow path to cutting rates. And I think that's what may be different about this Fed. Now, correct me if I'm wrong. Does Jerome Powell have a job in 2025?
How would I know that? I know he was all over, Trump was all over Powell when he was president.
Right.
And the one thing I don't necessarily believe Powell on is him talking about not making political moves. I think that he was kind of pressured to keep rates that low for so long.
There were when Trump was in office, there was complete political play between. I mean, there was a lot going on with. I mean, we saw like dollar manipulation straight up from Trump's comments to the Fed actually taking policy action. So I get it. There is pressure there, and even in this cycle, I mean, what would be? I mean, again, this isn't what I trade. I don't trade politics here, but the reality is, if the Fed is happy or comfortable with this rate cut in September because it would benefit the consumer, benefit the homeowner, benefit the housing market, that could keep this rally going. Is that enough to keep things, okay? But then you have the question of who are our candidates? Two 80-year-old candidates that are talking about once the gold.
Cutting. Sorry, go ahead.
No, I'm just saying, like this political cycle of people aren't looking at this election as like, oh, the economy's great because of our current president. People look at this as the economy's fine. Things are at all-time highs. If you're an investor, you're happy. If you're not an investor, you're not happy. If you have not been investing for the last 4 years in the market, you're not happy, because day to day, if you're living paycheck to paycheck and you're noticing that things are still more expensive, you don't give a shit that the markets are at all-time highs if you're not invested. So unless you have a 401k, unless you're invested, times are not any better for you. So this politically is not oh my gosh, this economy is so great, this administration is so great. That's not where we're at as a political decision coming up in November.
Yeah, I mean, all presidents do too is that they may create a problem and then the next one inherits it.
And then they blame who was before, and it's all a big puppet show, man. It's a big circus, and it freaking sucks.
I mean, rates didn't go up until Biden was in office, so I don't know. It could have been a different story if we had a different president at the time in place of Trump instead. Maybe rates would have gone higher sooner. Inflation wouldn't have skyrocketed as high as we thought. We were in double-digit inflation, and there was never a time in history where interest rates were low, or interest rates weren't higher than inflation rates in order to bring inflation down.
Mm-hmm.
So seeing what we've seen now, it's kind of unprecedented. But still, I feel like it's going to take a long time for interest rates to stay where they're at or higher for inflation to move down. And I mean, we have proof right now. CPI is not moving. I mean,
True.
home prices need
Neither
to
rate.
crash.
Like
Home prices are a big thing. But you know, house prices are high and mortgage rates are high, so it's very there is something that needs to crack. It's very obvious that something will at some point.
Yep.
Um, and then we'll leave it up to whoever's running for office to blame whoever. But
All right.
that-
Let's
we're creating a problem here.
Of
What
course
we do
we
is
are. What do
we
we
create
always do?
problems and then we blame it on other people.
Well, we create problems, we create booms and busts, and then the Fed fixes it. That's really been the last 20 years, right?
Yeah,
I mean,
but they
more
need
importantly was the intervention in 2008. When you go 2008 to now, that modern day Fed policy, Fed put, Fed backstop, that's essentially been the market. We burn something hot until it breaks, and then the Fed has to step in and fix it.
they need to stop stepping in to give.
What's that?
They need to stop stepping in to give, the other generations a chance. Like the wealth of people who have money, who are in their prime working years, 40s, 50s, 60s, who have a lot of accumulated wealth, have money to invest. But when you see a drop like in 2020, that thing went all the way back up in a matter of months. No one had a chance to really invest and build positions on that thing. So
No, but that was also an unprecedented, global fiscal stimulus across the board. So I mean, I
it's
think
still Fed intervention though. So
of course it is, and,
I mean,
this is the biggest problem. The biggest problem is if we don't have intervention, or we have intervention that all of a sudden starts to fail. That is the bigger problem. If we have the Fed trying to step in and cut interest rates and slash interest rates and be as dovish as possible and try to backstop something, and it doesn't work, that's when things are way more problematic, because we have gotten away with just buy the dip. Smart investors have gotten away with buying the dip because every time it's worked. Now that dip might be 10%, that dip might be 20%, that dip might be 30 to 40 to 50%. That's going back to 2008, we had 56% down. Going back to 2015, 20% down, 2018, 20% down, 2020, 25 to 35% down, 2022, 20 plus percent down, 25% down. It's not like you just every 2% dip you buy, right? Even though it seems like that's the play this year. But
I mean that you're right. Didn't you say we haven't seen a 3% dip or something in the last however many trading days? 200 something.
We haven't seen a 2% sell-off in the market in over 345 trading days. That's almost a year and a half of never having one single day with a nasty red day. Like a 1%, that's fine, but 2% or worse. And again, probability wise, that's an outlier. That's only happening about 15% of the time. But we've stretched over a year and a half without having a 2% sell-off day. It can last longer. I mean, we've had periods where it's been up to 1,000 trading days, which is a ridiculous amount. But anyway, let me get one thing out here on the charts. Okay, Frank, we're sitting at 557.20 right now in the SPY. Yes, the signs are there for technical overbought conditions, but like I said, and this is the most important takeaway from today's discussion, okay? If price doesn't support anything bearish, there's no reason to be bearish. This does not mean that I don't have protection. This does not mean that I'm not playing the other side in case something were to happen. But most importantly is, if price remains absent from the bears, then we just let this thing slowly melt up higher. And we're up 17% year to date, give or take a couple of percentages here, but roughly 17% year to date. How much further is it to stretch to 600? We're up 17%. And if I threw out the number 24% for the year, is that astronomical?
It sounds right. It sounds like it's going to go there.
Exactly. So I can see it being a realistic target. I can see the market may not give a crap about anything we're talking about and doesn't give a crap about the downside at all because it's not ready yet. But 7% higher is not that big of a stretch. It's not like 600 is another 10, 15, 20%. It's got to double the gains. Look, we can eke out another 4 or 5%. We can squeeze, we can blow off a top and capitulate up another 5, 6, 7%. I mean, heck, we could go up 10% on a capitulation move. So it's feasible, it's conceivable that 600 on the SPY, 6,000 the S&P is a realistic target, and that could be the market's blinders on destination for the year. And whether that's maybe we have a correction before the market offers maybe one more buying opportunity before it just keeps going, or what's going to be agonizing is like it just keeps making higher highs, and people feel like they can't freaking buy in until it's like FOMO. Maybe that's your capitulation is, and we have data, right? So we have CPI tomorrow, PPI Friday, and then it's a big hole in fundamental data, except for earnings. That's really all we have to fill the gap from now until the Fed in September. Yes, we'll have a couple rounds of CPI, and it might matter for that week. But if inflation is going to stay either sticky or trending slightly lower, that's not really going to shock the market in any way. The Fed's not going to change their stance. Powell's going to be the same with his narrative. But the earnings catalyst could be the other piece that the broad market has to probably show up a little bit more, in my opinion, to kind of help sustain and justify these valuations, these high concentrations. Doesn't have to.
What would you do on the first 2% drop day?
It's a good question. So if we had a 2% drop day, is it going to change my outlook on where we are currently sitting? So let's say that this happens by the end of the week. We drop 2%. Okay. Well, in order for me to see that the floor is breaking here, Frank, I would need to see price actually drop about 2.6%. That would be where the bears can make a serious threat to this market. Because if we can take out this floor at 242 or 243, that's 2.6% away. A 2% day, if we had it in a gap in a push lower, I'd probably look to fill that gap within the next couple of weeks. Probably. But what would I do? I'd probably trade both sides of it. I would say we've got a gap. If we fill the gap higher or go lower, I'd trade omnidirectional.
Okay.
I would do
Condor,
I do my debit spread combo. Yeah, I'd do something like that. It would open up the floodgates for volatility. That's the good thing. The first thing I would do if we had a 2% day is I look at the VIX. Where's the VIX at after 2% sell-off? Because if that thing's screaming up here to 16, 17, 18, I'm taking about $5,000 of profits on the VIX plays. And that's it. Like maybe it's a one and done. If it's enough for me for that hedge to make me $3,000, $4,000, $5,000, I'm just going to take it. On the the bear trap plays that I have, I'll be watching those closely. But then on the actual instrument, I'll probably trade it omnidirectional, go out maybe 30 to 45 days and see if I can get something to either fill that gap or continue lower. So it would be a big shift in volatility if we see a 2% sell-off day. Right now, the IV on the SPY is, I think, single digits. Oh my gosh, dude. The IV rank is 1.8. That is insane. That's so low volatility, dude. Even with my little daily strangles, you know how much I took credit for today? $2.
How much did you risk?
I mean, $1,700 to make freaking $35 on the SPX. It was a 35-cent credit that I collected on that trade.
Yeah, I mean, but your win rate is so, or your probability is so high.
Yeah, it's super, super high. And the trade was done by 10 a.m. I got on the trade at like 9:35, right after opening bell. 10 a.m. it was closed. It's so deflating to be like, I can't even get $3 credit on an SPX. Nope, I can't. Based on the mechanics of that trade, I'm not trying to get tighter to price. I'm not trying to play flirty with price. It's like just stick to the 15 delta, 15, 14, 16, 12s. Like if we have higher IV, then you can go out, 10 delta and you can still make as much or maybe more credit. But with this IV so freaking low, man, it's tough to be happy with premiums. So anyway,
I like the vertical plays. I like I have a couple call verticals on SPY and Q.
Okay.
On the QQQs.
Okay.
And
what do you have?
That is going out to the 12th. I have let's see. I have a 550 by 553. So it's a very small play.
So you're on the SPY. Is this a 550 by 553? Is that a put spread?
It's a call spread.
So you bought the
Yeah, I
550.
bought a 550 and I sold a 553.
Okay. Is that trading for $3 credit right now?
No, I got it at 155. It's currently at 260. So I'm up 49% on the trade, but
Okay.
it's not anything great, but it's working because if you were to just buy a straight up call or put,
Right.
they lose value super fast in a super low IV environment. So
Yeah.
the slow melt up for the past couple of days have been really good.
That's good. That's not bad. I mean, but your max credit's going to be $3, right?
Right.
Right. And you're trading at 260 right now?
Yes.
Okay, so you're at 87% of your max profit right now. I think that there's actually more risk in that trade to let it go to try to get the extra 40 cents than there is just to take the profit. That's my opinion. You've got about 87% you can guarantee the profit, and the remainder would be price has to basically just keep melting up. And it could, right? But here's the reality. Tomorrow is Thursday. If we gap up another dollar or two or three or five or whatever tomorrow, your trade is still going to be trading at like 270, 275, 280. Like you're not going to hit your $3 credit until Friday end of day. So you have a lot of gamma risk in that trade holding it until expiration. You said expiration was Friday, right?
Mm-hmm. And I've taken these almost every day.
Okay.
So I have not held on to them for that long.
Okay.
So the same expiration almost, different spot because the market has moved higher. So I start over basically in the money or at the money. And then by the next day or 2 days, it's in profit. So I'm not collecting the full whatever, but I'm collecting like maybe $1, $1.30 or 50 each day. So it's been okay.
Yeah, no, that's good. That's great. I'm looking at it from the max profit side. If you're up like any time, and I call this like the good enough. Anytime that I have my max profit and I'm up maybe 80 to 85 to 90% of that max profit, if there's time left in that trade, to me, it's not worth the potential risk versus just taking the profit now and being 85, 90% maxed out, because you can't make more than $3. You're not going to roll that debit spread. You're not going to make more than $3. So if you're up nearly 90% of that, I think that's the easy trade. That's the good enough trade. Is I'm up 87% of my max profit rather than sitting on it for 2 more days. Just take it, and you can also recenter it, redeploy it as you've been doing with the same mechanics. That works.
I also did this for Friday. I sold a vertical spread. So on the Qs, it's 507 and 508. So if it stays below 507, by Friday, I'll collect 13 cents. But that was supposed to be an extremely out of the money play. But that's $13 if you do one contract. So you have to leverage a lot to collect.
So your risk is 87. Your risk is 87 cents on that dollar.
Yeah.
Okay. So the number, let me check the numbers here. So if we go to the lows, 495 to 507 is a $12 move on the Qs. That's possible. I don't know, man. I mean, if it's defined, it's not the end of the world. The only issue is like if we have a down day, then your 13 cents will be easy. The bad part is you executed that trade for 13 cents, and that's the most you're going to get out of that trade. Yes?
Yeah.
Yeah. That's the downside. So the upside is, 507 might be tough to hit. It's right up here. But if we stretch from the low of the week to the high of the week, it is very possible that we can have a $12 move on the Qs. That's possible. CPI can blow that out.
I just think the move is going to be slowly up if it goes up.
But tomorrow's the catalyst, dude. All I'm saying is, look, you got slow, you got slow, you got slow. If you give this market a week, one day is usually going to be a directional day, right? Look at last week. Look at the last 4 weeks. Okay, slow, a little bit of direction, slow, little bit of direction. We had 2 directional days during a holiday, right? Thursday, there was no trading. The week before that, it was garbage all over the place. Slow, 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 crazy direction on a Friday. The week before that, you had a huge move on Monday, which was ridiculous, and then slow, slow, actually directional day on Thursday, and then slow on Friday. So my point is, you usually have one directional day. And when you get, and dude, I'm not trying to like poo-poo on your trade, right? I think the trade is fine, but 13 cents is rough considering one directional day, Frank. I hope for the sake of your trade that directional day is down because that makes your trade safe, right? If you took profit on your SPY trade, on your 550 by 553, take your profit, take your 87% max profit, and then the Qs, it actually sells off a little bit. That direction would help your position just to make sure that it's clear that you're making money. Because if this goes up higher, what's it trading for right now? If I look at that 507 by 508 bear call spread, it's not trading at 13 cents or less. It's going to be trading for more, right? You've got risk on the trade right now. Yes.
It's trading at 12 cents.
Is it really? So you have a 50. Okay. So you sold the 507, bought the 508. Okay. So you're break even on it right now. Here's what happens.
I mean, this morning it was at 15 cents.
Okay. What happens if we go up another couple of dollars? It's not trading at 12 cents. It's going to be trading at 20 cents, 25 cents, 30 cents, right? So, you know, you want price, like you said, to go up very slowly and have this. I mean, right now, this is still a 14 delta. I mean, you still have an 85% probability this trade's going to be fine. It's well outside the expected move. It's well outside the next couple of days for a $5 directional play. The issue would be this, okay? And maybe this is how you can still sit on the trade. Let's say price gaps up and then fades. You're still fine. You still make your 13 cents, but you're gonna take on some risk. If price goes up quickly with a CPI gap, for example, you're going to take on the risk. This is probably going to be trading for like 30 to 40 cents. But if it stabilizes, then you have one more day. You know, if it fades from there, you're fine. That's all.
In looking at what I was more comfortable with, I would rather do it to the upside than the downside, because if we do sell off during the day, it's going to be a much steeper drop, in my opinion, than a run higher. But yeah, I mean, there is risk. So I don't know. I could close out tomorrow or something for a loss or whatever, but I'm just looking at high probability trades that was like 80%. So
yep.
I don't know. There isn't a whole lot to do when the market is just doing stuff like this.
Yeah, so, I mean, the best thing to do is that if you're invested, you just watch your P&L kind of slowly climb. I mean, my big turnaround for the last couple of days, I want to say that my China stocks have been responding a little bit better. So FXI is up from yesterday. This has been, I mean, BABA has come nicely up. I mean, BABA's up $5 off the lows. That alone has helped. You know, some of my non-correlated positions, I mean, it's up 6%. That's been a big help. Baidu for me trading around mid 80s right now. Okay. So Baidu just had a ridiculous candle yesterday. That's insane.
That's really good.
This is awesome. And the nice thing is, let me check on Baidu actually. So I have a 102. Let me see here. I think I have a 110 on my Baidu because I'm doing a collar trade. Let me just check one account. This is kind of an easy one to reference. So I have 100 shares of Baidu per everyone's account. So 100 shares, everyone's got it. I have it collared essentially with an $80 put and a 110 call. I collared that move for about 20 cents. So I mean, it cost me 20 cents, but I'm protected to the downside, you know, 80 or below through August, and I'm covered to 110. So if price doesn't go anywhere, I own the shares around $96. So I'm actually in profit on the position. If price goes up to above 100, you know, I might look at maybe rolling this collar a little bit just to keep it kind of equidistant, but I'm going to try to get it called away. Hopefully never. In all honesty, like My play on Baidu is here. So I'm just trying to be. This is my low. My call on Baidu is I want this thing to go back to 150, 155. Now it's a long ways away from that, and we might sit here and we might have to stabilize a lot longer and do this nonsense before this thing bottoms out and carves out a bottom. But if I can bring my cost basis down, not get the stock called away, I'm trying to let this thing run back to 150, 155 before I take any profit. So I own it at 96. If I can drill it down to 90 or 85 and let this thing run to 150, 155, it's almost 100% upside for me. But it's going to take some crafty positioning on my side with options. But again, why is my P&L, big pop for the last couple of days? It's not because of this. It's not because of 3 inching higher highs. It's because some of my other exposure is doing okay. Yeah. So anyway, so this morning, what I do this morning, I did a trade on gold futures this morning. You might like this one. I know you're all in on Palantir. So I did put in a couple of trades on Palantir out to June of next year. So I just did a bunch of puts. I got $4 credit, 20, 17, 15, 13. I'm looking at these as short-term leaps, which is, so some people look at leaps as you buy the call option out 360 days. I do the opposite. I tend to be a seller of options. So I looked out 345 days. I sold those strike levels on Palantir. And again, maybe I take some ownership, maybe I don't. If the stock price goes up, I'm still going to collect $4 credit. That's fine for a little profit. But what I'm looking for is if this can help me generate, maybe $2 credit, I can redeploy it, do it again, and just kind of chase this a little bit. But I do have a couple of other trades. I think I did a ratio spread on Palantir. Yep. So I have a ratio spread. So I did the 20 by 19 ratio spread, and then I did all my puts out to next year. So I don't know. I know you mentioned Palantir. You like it. You own some shares of it. So I decided to do a little bit of participation in that as well.
I think it's a great long-term play. Although justifying a $30 price is kind of tough right now. Yeah. So I haven't really been building my position. I bought a good bit of it, and then I haven't done anything yet because I was kind of anticipating lower prices, but I'm sure they'll come at some point. But for now, I guess I'm just enjoying it. I would like to own more of it. However, I don't really want to buy it at 30. I'd rather buy it in the teens. But
for sure. What's your cost basis, by the way? What's your break even?
I think it's like 23.
Okay.
I've held it for a few years, and then this year I bought a lot more, and it was almost around the same price. So I kind of am. I'm not really that much in profit, to be honest. From 23 to 27, $28, it's not a lot. Okay. But I would like to own it, a little cheaper than that.
Yeah. Okay, that works. One thing again, if you treat that $23 break even as a core position, you could also consider, doing some out of the money bull put spreads. If you can generate 20, 30 cents on that contract. How many shares do you have, Frank?
20.
You have 20 shares. Okay. So this actually is pretty interesting for you. If you did, so you have 20 shares at, let's say, a break even of $23. All right. So you're all into this for 20 shares. Now, if you do a bull put spread, and let's say you did a, kind of out of the money, like let's say 23 by 22 bull put spread, and I'll price it out, but let's say we get like 20 cents credit, something like that. Because this represents 100 shares and you're only in for 20 shares, you're actually getting a 5x improvement in cost basis. Does that make sense? So if you did 20 cents in credit on a bull put spread, you're actually generating $1 lower cost on your 20 shares, right? Because you have 20 shares in a call or option contract represents 100 shares. So you're actually taking like a 5x leverage on that. So, I mean, in a way, you obviously don't want to lose. You don't want to lose on a option trade. But if you did something that's relatively safe, high probability, I mean, let's price this out. Let's go 23 by 22 on Palantir just for demonstration purposes. and maybe you like it. So here's Palantir. Here's a trade. If I went out, let's say to the end of August, we have earnings on Palantir August 5th. If you want to do something prior to earnings and not be exposed to that, maybe that's a good play here to go 23 days out. Could I do, look at your deltas. Here's a 13 delta. So if I did like a 16 delta at the 25, so here's a trade, 25 by 23. So it's a $2 spread. You're collecting 19 to 20 cents on the trade. You know, is there risk on the trade? Yes. If you treat it as is, you know, are you going to take 100 shares of stock? Probably not from the sounds of it. But if you're correct on this trade with a move that's about an 80% probability, about an 84% based on the deltas, if this is before earnings, there's not really a catalyst to necessarily drive this price lower. If you made 20 cents on the trade, you would effectively be lowering your cost basis by $1. So you're 23.
25 by 23.
25 by 23 bull put spread. Yep. So you'd sell the 25, buy the 23, collect 20 cents. And if that trade stays to expiration, you collect your full 19 to 20 cents, multiply that by 5 because your 20 shares would be representing 100 shares of savings.
Yeah.
So you'd save like $1. And so what I'm saying is if you take these, like, there's going to be more risk than reward if you want to stay out of the way. But if you did that over the next maybe 30 days, 30 days, 30 days, I mean, realistically, you could take your 20 shares and lower your cost basis by $2, $3, $4 and own Palantir in the teens, like you just talked about.
I think I more so consider it as like an income generator rather than a cost basis thing. If I were to do bull put spreads on the shares that I own, I mean, they would be independent of each other. So it wouldn't necessarily be a lowered cost basis. But if, say, I owned 100 shares of Palantir and I sold a call, I think that could be more considered lowering your cost basis. But I mean, doing a bull put spread on the same stock that you own isn't, I don't know if I would say, oh, that means I own it 15 cents lower or something.
Well, the reason that I say that absolutely matters is because what happens when the stock's in a drawdown, right? Let's say that Palantir comes back to the teens. If you were telling me like, well, I made all this income, but now I'm in a drawdown for my $23 net position. Well, if you actually had income generated and you knew your cost basis, you can say, well, I actually own Palantir based on the income I've generated from it. I could own Palantir at $19, $20, right? And that way I know if I want to sell a call and kind of protect myself, I could sell a 20, I could sell a 21 and get maybe tighter to price on some type of drawdown. So, I mean, to me, it's absolutely important that you know your core position and you can treat it as income. But if you are going to own shares, why not try to own shares for free, right? If you did enough option trading around Palantir, you could own shares for free. And then your cost basis is nothing. And then Palantir has unlimited upside because you've worked your cost basis down to core positions and options.
That's
so
true.
I think it's important to track. It's the one thing that, I mean, I think you and I talked about this. It's the one thing that brokers don't track for you, right? I got to track down this spreadsheet.
The problem with that though is you own it at a certain price and you take that bull put spread a month out or something, and then you get your trade kind of closes out in the red. So then you technically own the stock at a higher price.
True. It's the same. I mean, it's the same thing. We're having the same argument. I'm just saying that if you treat it like a core position, what you do with options around Palantir, if you want to isolate it, say it's for income only, okay, fine. But if you're going to own the shares, everything you do with options could actually affect your cost basis. Hopefully for better, you want to improve your cost basis, but in the event you lost on a credit spread, yes, you would lose and you'd increase your ownership price. But that's why you know options and probabilities up front, where you're like, okay, this trade has an 85% probability, 90% probability.
This is on Webull, it says a 25 by 23 is 20 cents.
Yeah.
So a month out, that's 20 cents. I'll be risking $180 to make 20 in 1 month.
Okay. You're risking 87 cents to make 13 cents. You can't tell me this trade is garbage.
That's a much shorter time span. That's in 2 days. This is in like 3 or 4 weeks.
Okay, so you're telling me your risk is worse. You're willing to risk 87 cents to make 13 cents for 2 days. This is at least like, look, you're taking this on probability that it's an 83% probability of profit that will just stay where we are. Plus we have alignments and momentums and things look okay.
There's so much time in between them.
Oh my gosh, there's so much time. Dude, if you look at options trading, if you're a seller of options, Frank, time is your friend. Time
Do I
is your
just have the
friend.
wrong outlook on options? I feel like you want a shorter time span if you're selling options like the one I'm doing on Qs. Yeah, it's only 13 cents, but that's in 2 days and time is going to be working in my favor up until then. And
Right.
here,
But your
this
risk
is
is
a month
backwards.
out. This is a month out for not that much more credit. This is 20 cents versus 13. 20 cents in 1 month versus 13 in 2 days.
I understand. It's interesting your logic around this whole trade that you are taking exponentially more risk in the 2-day window if you're wrong, right? There's actually intrinsic and extrinsic value in this trade by time working in your side. Theta is on your side in this trade out 30 days. I know it's 30 days, right? But also it gives the market a chance. If it's going to drop down for a day and then pop right back up, this trade's fine. If the Qs pop up, your trade for Friday is screwed, pretty much, unless it absolutely stays below that line at 507.
Yeah.
So
Yeah, you're right.
I'm just telling you, dude. In the studies have shown if you're an option seller, time is a good thing because it lowers volatility. Period. You want lower drawdowns, you want tighter volatility, go out further in time. That's the best thing you can do.
I like less time. I like not having to hold on to something for so long.
Oh my God, Frank, you are the antithesis of every long-term investor right now. Like,
But I am a
what would
long-term
Benjamin
investor.
Graham or Warren Buffett be saying right now to you, Frank?
I don't
Frank,
invest in
I
options.
like less time, Mr. Buffett. I'm sorry.
If I'm buying and holding, yeah, I want more time. But if I'm selling options or buying options, I don't want more time. Well, when I'm selling options, I mean I want less time.
Is that because you're impatient? Is that really all it is? Is it because you want instant gratification, Frank? Is that what it is?
Yes.
Okay.
I want
I
it
think
right
that's what
away.
I think we found the answer. That's probably what the answer is.
As soon as I take the trade, I want that gratification.
I take the trade. I want profit right now. Yep.
We're at 13 cents, so I'm at break even right now for the Qs.
Well, I know for me, I don't want to micromanage trades day to day. So, I mean, I've got a trade this week on the SPX. My trade is, where's it at? I am looking at a trade for, I think I did the 5. Where's the SPX at? And then I gotta wrap it up here. I'm a little bit late for my trading room, but this is a good discussion. I had a lot more fun today than yesterday, dude. Yesterday you just weren't feeling this. You weren't feeling this live stream at all.
No, I mean, I don't really feel it in general. I like talking about it. I just don't like being on the live stream, especially when it's every day, you know.
Oh my gosh.
But
You're a hard man to satisfy, Frank. All right. I've got a credit spread on my SPX. I've got a 5565 by 5560. I collected on the trade $2 credit. Okay, $2 credit. I'm already up $70 on the trade. If we get a gap higher, this will be even better. I'm probably just going to hang on to it to expiration. We're still trading it so here's the good and the bad, right? The good trade is it's now in profit. I collected $2 credit. It's trading down to $1.30. So it means I'm plus 70 cents. Now my max profit is $2. So I'm not like, oh, I'm at 85, 90% of the max profit. I'm not there yet. So I'm not going to close the trade. I do know this. If price goes higher tomorrow, this will probably drop to maybe 70, 60 cents, 50 cents, something like that going into Friday. By Friday, I'm just going to let it close. The expected move will be way out of the way. But the risk is this. If somehow the market drops tomorrow, I have $3 risk on the trade, which I'm okay taking because I still put in a trade for next Friday that is a deep in the money bear call spread for 450. So I look at this two ways. If somehow I make my $2 this week, I can lose 50 cents next week and still walk away with $1.50 net profit. Okay. Or I flip that, I can lose $3 here, make $4.50 here, and still walk away with $1.50 profit. So I'm positioned for this to either stay where it is and make me money, or go down and make me money. So hopefully over the next 2 weeks, I'm net positive on these positions. So not that difficult, but just that's the trade I'm watching for Friday. I'm still looking at this to see if the market is willing to give me some big gamma level to go after. I don't see it. I was kind of hoping that the 560 would light up here and get a little bit bigger, but it's just not. So we're sitting at like 712. This was over 1500 today, but we opened we opened at it, so I didn't have a chance to actually participate to it. So anyway, I want to see what the news is. What's that?
Just today it pulled back and then it came all the way back again. But I mean, I wasn't even really looking. It's such a slow move up. Just so crazy to me.
Yep.
Just it never stops.
It doesn't have to. It doesn't look, man. It doesn't have to be exciting. Believe me, traders are like. I mean, you sound like you're bored by this market making all-time highs.
Yeah, it's desensitizing to see all-time highs every day. What's new?
Well, I mean, if you're participating, you love it. But my point is, what is not as exciting is when this happens and then everything in your portfolio is freaking out, volatility is changing. That is where all this risk is right now, like accumulating. Is this potential like outlier risk of if we have a down move and the VIX goes nuts and volatility changes, all positions are going to be, it's going to be weirdly red. Like, look, I'm hedged like crazy. And I will still be looking to make sure, like, okay, are my hedge positions like okay? Are they paying off? Is it bulletproof my portfolio? You just don't know. And right now, over the next 20 to 30 days, over the next maybe 30 to 60 days, outside of earnings, and honestly, like earnings doesn't matter, dude. We're gonna go through another 5,000 or 6,000 companies of earnings, and maybe 10 or 20 matter as far as what the broad market can actually do and be lifted by. But that consensus will be interesting to see how it plays out. And then fast forward into another round of inflation data, more Fed talk, maybe minutes in August, but there's nothing. Like it's now, and then it's going to be September. And the fill in the gap is going to be earnings season and Jackson Hole. Those are the next, those are the events. And so, like I told you, man, if we're looking at the SPX or the SPY at 1.8 IV rank, dude, I am not buying a single option for earnings season. That volatility is so low. I would be wasting money if I'm going to put on debit spreads during earnings season, because we'd have to be banking on at least hitting the expected movements in this all-time low volatility environment, which is really tough. So if I do expect the moves, it's going to be based on credit spreads, and I'll do those in the money credit spreads. So, I mean, we can spend a lot of time on that in this session, or you and I can talk offline, but I'm really cautious going into earnings season for that reason. Like, I think we're going to get, if it's going to stay this low volatility for a while, I don't want to be paying a bunch of debits. So anyway, just my thoughts.
Yeah, I think, when earnings season kicks off again, we should have more discussions about it.
More instant gratification for you, Frank.
Oh yeah.
Oh yeah.
I'm betting on volatility. I'm betting on moves happening way past the expected move.
Okay.
So
Frank's all in. He's all in on earnings.
I go all in and then I'm all out.
All right.
And I have to refund my account.
Yeah, just add more to it. That's all.
Yeah.
Risk capital. All right. Just kidding.
All right, Chris.
All right, man. Hey, dude, you survived a nice, solid, long session today. Yesterday, you were like, it's 11:15. It's been a while.
I mean, it's a lot. I'm exhausted now.
Oh my gosh,
being
dude, I've
behind
got
the
another
camera is a
session after
lot.
this. That's what I do. I mean, how do you not enjoy this more? Right? We're just sitting here talking about hopefully something you like.
I like talking about it. It's easier with you too, because we can. I feel like I've learned more about options, and like we also have a decent understanding of the market, so it's easy to talk. But I mean, doing it in front of like a couple hundred people every day for like an hour. I don't know, it's a lot.
Oh,
Hello, guys.
Papa
I'm
Nixon here.
I'm
We
here
can-
pulling the plug. I'm the
Oh,
bad guy.
okay.
Power's going out on the stream.
All right.
No, you guys did awesome. I was listening to some of what you're saying, and I hear Frank's point too. Camera time, Chris, you have an unbelievable stamina on camera. I think you're the only, like, you've got me beat, and I spend like hours a day on camera.
I know. I'm usually live for like 4 to 5 hours a day between sessions.
That's crazy.
Yeah.
That's crazy.
So
It's impressive. Anyways, I want to thank both of you guys for hanging out on stream. And before we do shut it down, I did want to mention to anybody who enjoyed that commentary from Chris, we still got a bunch of people watching. So make sure you guys can go find Chris's Discord. You can find his YouTube channel. We'll drop the link here. And if you're watching on Twitter, it's at Real Chris Pulver. You can also find A1 Trading on Twitter. You can find me on Twitter, all that good stuff. So Chris, Frank, thank you guys for hosting and for taking over. And we'll see you guys back tomorrow.
sounds good. Thanks. See
All
you
right.
guys.
See you guys.
Thanks for tuning in to today's A1 Trading Show. Make sure to subscribe and to turn on post notifications so you don't miss the next one. Also, we're looking for more guests to come on the show. If you're comfortable being on camera, have trading experience, and you're looking to grow your audience exposure, we'd love to have you on. In the live stream chat and description below, we'll drop a link to apply to be a live stream guest and join in on the conversation. We hope to have you on soon. That's all for today. Trade safe, and we'll see you next time.